So thank you again. So we're going to have a panel which is going to focus on the role of fintech and data in the sustainable finance space. Sustainable finance for ICMA, and unsurprisingly, is very much about sustainable bonds, but not only. As those of you who know me, I've for many years have been leading our effort in sustainable finance, and this has led us collectively to achieve a global standard for sustainable bonds, and everybody is generally aware of what is a green bond, sustainable bond, etc. Now, I'm very pleased for this panel to be joined, and I'll go from left to right, by Krista Tukiainen, who is co-founder and chief commercial officer at ClimateAligned. Then we have Adeli, who is ESG sustainability at Janus Henderson Investors. Samuel Mary, who is the Senior Vice President ESG Research at PIMCO and also a member of the Executive Committee of the principles which develops the best practices for sustainable bonds. And I'm very pleased also to have Sabine Farhat, Head of Securities Finance at Murex. Now, to kick this off, I'm going to ask each one of my panelists to just sort of tell you where they are in the fintech space, and let's start with Krista.
Does this work? Yeah, it does. Thank you to ICMA, Georgina, and Nick for having me. Indeed, ClimateAligned is a climate fintech company specifically focused on making data on sustainable fixed income, so sustainable bonds of all varieties or ice cream flavors, as Sean Kidney would say, accessible. So we help investors and the DCM, so debt capital markets bankers, to identify what good looks like against any opinion, which there are many, as we know, where there's gaps and where there's oversupply.
Hi. Thank you very much, Georgina, for inviting us, and thank you very much for hosting this panel. My name is Adeli. I've been in financial services for almost 20 years. I've started my career in computer and machine learning, just down the road, actually, in UCL. Focusing on genetic programming and genetic algorithms. And since then on, I've worked on various components of data and quantitative elements, from structuring all the way to quantitative modeling and using big data and creating golden sources. Currently, I'm in Janus Henderson. I've been there for a year and a half, and we look at the end-to-end sustainability journey all the way from data coming in to the firm and going through various hips and hoops to the reporting for regulatory purposes.
Just speak into it.
Can you hear me? Yeah. Good afternoon. Thank you very much to ICMA for the invite. So my name is Sabine Mary. I lead the climate change research at PIMCO. As it relates to fintech more broadly, just a brief element of context. So PIMCO is a global asset manager, principally active in fixed income across both public and private markets. We manage over $2 trillion in terms of AUM, and a material portion of it is subject to sustainability guidelines or criteria. In practice, when we think about the data, ESG data, sustainability in relation to my context, there are two main perspectives. The first one is about getting access efficiently to high-quality data to support our research, evaluation. And number two is also as it relates to the internal analytics, the proprietary scoring methodologies frameworks that we also develop, and make sure that we enhance these frameworks based on the latest state-of-the-art capabilities. And in terms of use cases, when we think about ESG data and the role of fintechs, there are broadly two of them that we distinguish. The first one is what we call ESG integration, which means firm-wide how we analyze sustainability-related financial risk. Number two is for dedicated portfolios in addition to financial objectives, sustainability objectives, how this enhanced ESG data can also help take a more forward-looking view, more informed, more complete evaluation in order to optimize these portfolios accordingly. I'll give you two brief examples of areas where some fintech have been helpful. Number one is about anything to do with sentiment or reputational risk linked to ESG factors, which is associated with the first perspective I described, the firm-wide ESG risk evaluation. And number two is anything to do with forward-looking assessment on decarbonization, because climate change is particularly mature as an ESG theme, and that's an area where there is a lot of interesting development in relation to fintech and carbon data.
Thank you as well for inviting me to the panel. So I'm representing Murex. Murex is a cross-asset multi-function platform. So we are a single platform that users can use us to do trading, hedging, funding, risk management, and operating the trades. And in that sense, my contribution will be more to focus on repo and other aspects of trades and how we can benefit from the different data in order to see what is the profitability views, how we can inject this new information on the market to make the repo space and the fixed income space more operable and profitable at the same time.
Yeah, and I should have mentioned actually that ICMA, beyond the guidance provide for sustainable bonds, we've actually provided initial guidance to repo. Some of you may have seen there's also a survey that came out a few weeks ago, and one of the conclusions of the survey was that the market wants more guidance. So we've got a plan for 2025, and while I'm on announcements, I'll say that we're also hoping to publish something on sustainable CP in the next few weeks. So we're broadening our footprint, but that's somewhat by the by. Coming back to my panel, and starting with Samuel, you've always sort of breached a bit the topic, but I would be really interested in your view on what is the real opportunity that fintech presents in the sustainable data space, or more broadly the ESG space. My expectation is that it's going to finally allow us to exploit the data, because it's not like we don't have data. We've got tons of data. We've got incredible multiplication of reporting frameworks, many of them are regulatory driven. So I would have thought we're drowning in sustainable data at this point. So the problem is sorting it and exploiting it. But maybe you've got a different perspective.
So I think the key term in relation to that is productivity or efficiency. When we think about it, there is a lot of data. But to give you a concrete example, as it relates to labeled bonds, such as green bonds, when we undertake our due diligence, so we assess their ESG characteristics and credentials, we need to look at about 10 different documents, if we include the presentation, the framework, the second-party opinion report, the allocation report, and so on. Well, obviously, the hope is that these AI-related tools could make it much easier to extract the existing reported data, put them together in one place through a consistent framework that is associated with our own scoring methodology, associated with our own reporting towards asset owners, because there is a lot of interest in green bonds, also in relation to impact reporting, so making a positive contribution to decarbonization as a concrete example. At the moment, this work is manual, relying on third-party data or various sources in order to get some portfolio-level metrics on carbon emissions for green bonds, while AI could obviously help in this regard. And then there is a topic of data traceability and data integrity. So similar to financial data, but you can argue for ESG data, this challenge is exacerbated because it's less standardized. So for us, being able to also access what can not only be reported data, but some data coming from the real economy. And I will give you a concrete example. When we think about carbon, we don't want to only rely on reported data from issuers. If we get better methane emission data based on satellite in certain regions, similarly for deforestation, we don't want to rely on backward-looking data from issuers on their contribution potentially to deforestation, but what's actually coming from the most recent and the most robust local sources of metrics. So that's where we see some interesting developments at the moment.
Thank you very much, Samuel. Coming to you, Ali, I know you're particularly involved in the whole regulatory aspect of this, but over to you.
Thank you. So I want to complete what you said regarding data. In the data field, especially when we come to sustainability, it's slightly different to what or at least what I've seen before. When we used to model bonds and equity and creating forecasts and creating curves, we always had these concrete data that we relied on. Everyone knew what the equity price, share price of IBM was on September 18, 20 years ago. It was fixed. But these days, it's slightly different, especially when it comes to sustainability. You have, as you mentioned, we have a lot of data, but these data becomes aggregated at some point. They become joined. And I'll give you an example. For instance, let's say when it comes to rights, women rights, LGBTQ rights in the S category. They all get aggregated on the top. Now, one company might have one more than the other, and another company might have reverse. But because these are weighted equally, they have the same ratings. So what do companies do? They, if they want to keep their rating as they are, they add one from one side and they may decrease one from the other. So it's basically becoming a zero-sum game. You would be able to, and this is what academic would say, you would be able to add, diversify your board, and in return, you would be able to create CO2 emission. And because of that aggregation, this would be the same. So there's a lot of challenges, not just to the quality of the data that we're receiving, but also interpreting it and aggregating it. Now, this is one part of it, which is the quality of the data. The other part is the interpretation of the data. The other part is harmonization. When you look at, as a buy side that we are, we buy data. And when we look at the data that we're buying, you have firms sometimes contradicting each other when it comes to specific firm A. One vendor might say, this firm is good in human rights, and one firm might say, this firm is lacking in human rights. Now, how do you compare those? So then when you go through that chain, the interpretation of the data, and when you go down, they're interpreting it in the correct way. I can come in more detail into how the interpretation goes, but they have their point of how they're interpreting it, because at some point they say, this is more important. This issue is more important than the other. That's why the rating is higher. It's all about interpretation. And then they all go back to the regulatory and the reporting and how we need to harmonize that reporting, at least so that when the regulators are looking at the report, they're not seeing data all over the place. There's that harmony, there's that comparability.
Yeah, I mean, you talked about LGBTQ+, but let's take something which has sort of science-based elements to it, like the EU taxonomy. I mean, do you think there's the same problem of variability in terms of the data that you're receiving?
Yeah, I mean, it all comes back to vendors. Right? We're not sourcing the data. Vendors are sourcing the data. And sometimes we get raw data, but sometimes we get interpreted data because they get aggregated. I'll give you one example, and this is the example I used previously, indigenous population, what we talked about. Now, you have two firms looking at indigenous population. One is looking at economic prosperity. One is looking at cultural preservation. Now, when they assess the firm, one firm cares more about cultural preservation, one firm cares more about economic prosperity. Their ratings are different to each other. So even when you're trying to compare apples to apples, you get different kinds. Even when it comes to something very, very simple.
Now I'm gonna turn to Krista, first, and then Sabine. I mean, you've heard some of the asks. To what extent? And by the way, don't talk too much about AI yet, because we're going to talk about AI in a minute. You can talk a bit about AI, but we're going to make a specific section. But how are you trying to respond to this? And how do you feel empowered as a fintech to respond to some of these issues?
You'll notice that in my introduction, I omitted AI completely. I was smiling when Sam was speaking because I've spent just shy of 2 years building what he was describing for sustainable bonds, which is coming to market this week, so shameless plug here. I think the potential is, like both of you
We're
said.
going to have to charge you more for that.
It's all right. It's all right. That's all, negotiable. That the potential is in what both of you said. One is and we think about this in a way of having basically 1,000 robot interns in your pocket or on your desktop to give you either internally built or built by a service provider, technology provider, an interpretation layer to the source data that you have to interpret anyway. And it's then up to you and anyone else interpreting the data to say what those rules of interpretation, the translation framework, if you will, should be. Now, there are things that are available out of the box thanks to folks like the EU Commission, and I was involved in my past life at Climate Bonds Initiative in putting together the EU taxonomy very heavily, and other regulated and semi-regulated taxonomies, of which there are 40 plus in the world right now. But at the end of the day, to make a compelling case for why you're competitive as an investor or why you give the best advice as a DCM banker, you're going to apply a proprietary lens to it. So that's where there is, I think, the highest potential. Now, it's not perfect. We heard in the previous AI discussion today where there's still some challenges, and I'm sure we'll touch on those in a moment. But what is now exciting and possible, and I'm obviously limiting this to sustainable fixed income for now, so take everything else with a sort of grain of salt and interpret for yourselves, as it were. What is exciting is you can collate and process and ensure sort of timely data that you can then interrogate against these types of rules. And that is a huge productivity gain and effectively a way to test ideas in close to real time on what the market looks like. That wasn't really possible even when we started this company 2 years ago.
And Sabine, over to you. I mean, you've got a slightly different perspective on this.
Yeah, exactly. So from where I stand is a bit different. In a sense, I'm standing in a different space on the market. So we are more post-trade. So the importance for our client today is, of course, to, as Ali was mentioning, is to be able to interpret which ESG factor, for instance, to include in an eligibility criteria in the repo space or collateral space, or in risk management, as we cover risk management, which factor. And in that sense, we, as a software solution, we only provide the capacity to be able to inject all this type of data and build on top of them a model that could recalculate an internal factor. At the end, when we are trading, when our clients are trading, they want information that they today are using to decide or to calculate risk on that. And so what we are providing in this inventories or eligibility checks or like a profitability sustainability report on how their portfolio is covering investing, the different type as well of sustainable products, financing product. Today, this is what is interesting. And so the tools that we are providing today for our clients are dividing their portfolios in if I'm doing financing on a repo, is the collateral, what is the rating of the collateral when it comes to sustainability? Or if the cash, if the repo itself is sustainable, it's still a dilemma for our clients whether to include the sustainability in the eligibility of the collateral. So there is a lot of topics as well that are quite open on the market when it comes to that. And what we are trying to do is to prepare to potential regulatory that can come and changes in even in GMRA or any other products on the market. And in that sense, your sustainability report that you were just mentioning is a key to a software provider that needs to be having a market watch, to be partnering up with our clients who are traders or IT of banks in order to be ready for any regulatory that is happening or is shift on the market.
And just as a slight segue, one of the key points we've been making from the beginning, and it's sort of self-evident, but it's very important to say, is that there is serious limitations in terms of the inherent sustainability of repo, right? It is a refinancing, it's a liquidity tool. There are financing repos, but fundamentally it is a support to other instruments. And so the debate is you know, as you were saying, more about the collateral and also to a certain extent about the counterparty. I mean, there's some interesting issues which don't arise so much in the sustainable bond market. And one of the things we're trying to do in addressing greenwashing is drawing this out and not let the market run away, you know, marketing sustainable repo and then find themselves in an awkward conversation at some point about, well, you know, what do you really mean by saying that repo is sustainable? As it's significantly less straightforward than a bond. But again, that's sort of by the by. So,
but I would add, even as well, it's complicated today. For instance, we build a portfolio on how the level of HQLA you are having through whatever type of products. And considering there is a lot of discussion that considers the ESG factors on products, on assets, as a credit or as a risk factor. It's a bit complicated from a software perspective, even though it's possible, like there is nothing wrong of doing it technically. It's the fact that we're doing the whole chain makes it a bit different how we calculate the CVA, the real credit risk, if ESG becomes a credit risk factor and not like Earth collapse factor.
okay, we can talk about AI now. I actually, rather than starting with Krista, I want to start with Ali, because Ali wasn't quite clear, but he actually started his career working in LLMs. And we had a really interesting conversation about what he thought were the inherent limitations. So over to you, Ali, and you can educate us.
I wouldn't dare, especially over here. Yes, actually I did. I started machine learning 20 years ago, and I've seen the progression over the years. The interesting fact for me is machine learning at that time, and actually even in 20 years ago, there was a discussion of sentiment analysis as well. And since then, there were hedge funds who focused on sentiment analysis, and some of them succeeded and some of them didn't. So there wasn't any proof of how the correlation exists. But nevertheless, when it comes to AI, ML, and all of the branches around it, it really depends on what kind of a data you have. This is a process. It needs learning. It needs decision making. And we would be naive for now to say that the data is good and the ML would be perfect. It's all about underlying data. And when it comes to sustainability, you have to add something on top of that, and that is the interpretation of the data, what that data means. Previously, we had in the credit risk world, we have CDSs, we have CDOs, we have all these curves coming around, different maturity, and we would be able to create our yield curve. We would be able to forecast using our simulation, whether it's Monte Carlo or anything else, up to whatever maturity that we desired. And with thousands of scenarios, and we would be creating our potential future exposure, so on and so forth. But nowadays, when it comes to sustainability, can we rely on those data? Do we have to create that risk factor where the data is will be fluctuating depending on changes that we'll get? Right now, we're seeing vendors changing methodology midway. So the number 5 that you had for deforestation. I'm giving an example, by the way. If there's vendors out there, don't quote me. But for instance, if there's number 5, then after methodology change, that would be different. In fact, actually, one vendor had methodology change, and I think it was in fund space where their AAA dropped by something like 60%. And then it all normalized as a result of that change. So yes, in that previous world, we always had that good data, but in that new world, we're seeing noises. Now then the question becomes, how do we decrease that noise? How do we put an alpha or decrease an alpha on that noise to seek the truth, if there is a truth when it comes to sustainability? Because it all goes back to what you think, what your perspective is when it comes to sustainability. So that noise, and there is an academic papers on this, regarding this, specifically regarding the noise on ESG data, is that how do we apply that, and how do we benchmark it against what we want to achieve? What is it that we want to achieve at the end? Do we want to have just data coming in, or do we want to see some actions when it comes to firms? So these are the discussions that when it comes, and AI is, I think, is helping those discussions. Now, in the case of particularly this panel, I would say that AI for now would not be able to make us decisions on which way is the correct way. And I don't frankly know how it will evolve when it comes to sustainability. But what I do know is that it'll give us a lot of different options and a lot of different variations of how we can use AI in different contexts. And I think that's a good thing.
Okay, Krista, you got to respond to this.
I agree. And I think for anyone interested in the lack of correlation between ESG ratings, I would highly recommend the MIT's Aggregate Confusion Project, which I think is the best named research project ever. Looks at this in great detail, and Ali's obviously the expert here. I think it's also worth distinguishing between what we mean when we say data. Your work is vastly different to mine in what kind of data we aim to interpret and in what way. The wave that started with the GPT models that were referenced by the panel earlier, that OpenAI launched, sort of the most well-performing ones in October, November 2022, so just shy of 2 years ago, are really the catalyst for being able to interpret language at scale. We've had natural language processing before, but that was really limited. And so that means retrieval, augmenting it with something, so retrieving information from language-based, so mostly qualitative information, which is what sustainability assessments are full of, augmenting it with parameters such as Samuel's ESG bond assessment framework, and then generation of an answer to a specific question. It could also just as well be for an EU taxonomy assessment, for example. Now, there's limitations to that, for sure. We actually spend a lot more time doing just data engineering and software engineering in these systems than we do on the AI piece. We do that, obviously, and we fine-tune the models. We prompt engineer a bunch to make sure that they don't hallucinate, they're accurate, they know what they're doing. We don't train anything from scratch because, honestly, unless you have as much money as Google or OpenAI or Meta do, then good luck. So just using the stack and making it work for a specific use case is possible. What they can't yet do, and I don't know if, to Ali's point, they ever should really do, is be fully agentic, meaning this is a full workflow that I'm letting the AI agent conduct from end to end. So do the retrieval of info, augment it, generate the answers, and then make a decision. Draw any reasoning on top of it. Make a judgment call. They're really, really bad at that at the moment, and that will maybe be the next frontier. But I think at the moment, what we can really well and efficiently do is this sort of processing at hyper speed and scale and to a high degree of accuracy, provided the engineering parameters have been met. Anything beyond that is still probably at least a few years away.
That's really interesting. I'm with Samuel's help, I'm going to bring this down really to sort of a pragmatic issue. I mean, one of the things that we do for the sustainable bond market on our, through our work on standards is templates, reporting templates, and it's the old-fashioned stuff. We put together a Word document with boxes, and we ask questions, and we say, please answer consistently in the boxes, and then we get out, and then we, put it through an Excel spreadsheet, right? I mean, it's just as far away as you could get from a fintech solution as possible, and nonetheless, this has been. We hear back from data vendors that this is really helpful. They're saying, well, please send us, your Word documents and your PDFs, and we'll interpret this stuff, right? Now, ideally, this is all going to disappear. Now, nonetheless, today, we are concretely at the executive committee of the principal saying, well, we're going to do more of this stuff because we've got a demand. And I like Samuel's perspective on this. Can we just give up on creating these standardized formats and relax? So we've got a fair amount of this still to do.
I will echo some comments that have been made before regarding being cautious as it relates to the existing use case or how far we can go based on AI, which means in practice that a hybrid approach, which combines the traditional old-fashioned evaluation based on templates, based on documents that have been reported by the issuers, in combination with the more advanced AI-driven tools, acknowledging their limitations and being fully cognizant of the potential caveats, makes sense. And we think they are complementary, because even if you think about an AI tool for the most basic task, I'll take the example of summarization, we would still need to be able to see very clearly the sources that are informing the summarization, be able to drill down into it, which means ultimately looking at the spreadsheet. And we need this level of confidence as part of our ESG research or ESG reporting. There is constantly this monitoring of data quality that takes place, and the need for us to be able to trace the origin and understand what's the data quality. So we take the example of carbon, for example, where there are some existing frameworks that allow you to classify data on a scale from 1 to 5, 1 being the highest possible quality, 5 the lowest. So similarly for AI, for any data point that we get as a result of these tools, we need to be able to identify this data and what's the actual level of quality. We need also, based on what has been said before, to have a clear framework, a clear taxonomy, so that the definition, the terms are fully aligned, not 90%, because whenever you live with an Excel spreadsheet or template, a bit of freedom for the user, you get some differences, some discrepancy, which ultimately hampers the aggregation. And when we think about AI, taking a long-term perspective, there's probably this sort of spectrum where we start with the most basic tasks, such as summarization, such as the analogy with financial data. So thinking about ESG data as an additional source of data, but with the same sort of use case, same framework as financial data. For example, long-term financial risk evaluation, often when we think about climate change as necessary, and that's an area where AI can potentially help if you think about the weather, climate physical risk as a source of risk for companies in the future. That's stage 1. But then if we move, there is probably the stage 2, which is, for example, the peer comparison, meaning you get, thanks to these AI tools, a more efficient benchmarking of companies, portfolios, any types of assets based on these metrics, instead of having to input the data yourself. But then number 3 is probably the most advanced, which is combining this quantitative and qualitative data, so elements of summarizations, elements of peer comparison, so that you get also some meaningful analysis or potential tentative conclusions based on all these metrics, and potentially aggregating not only Excel files, not only reported data, but portfolio level metrics, asset level data, and you start growing the set of data that you utilize. But even for this third use case I described, we are still considering these tools as an input, as an assistant, as a sort of very advanced intern that will help our research.
Senior intern?
Sorry?
Senior intern?
Indeed, or an intern 2.0. But ultimately, we will still need to own the assessment, own the view, and own the conclusion based on our own evaluation.
Okay. Sabine, again, you may have a different perspective on this, but to what extent is AI encroaching on and helping what you're doing?
So today, the AI part at Murex is more on the derivatives pricing model. So it's for the products that are sustainable, it's less demanded today. In a sense, we're not building factors. However, as mentioned by Simona in the earliest AI, the number of computation that needs to be done in the context of some complicated derivatives for risk management today have risen the need to be able to use deep learning in order to generate the accurate results in this context. And this as well in a sustainable manner because it reduces the usage of machines. So it makes the banks that are using this AI technology more ESG friendly in a sense. They are using less machines to generate the right numbers. So it's a different aspects of sustainability from
the footprint reduction.
Exactly.
Yeah, that's very interesting. Okay, I wanted to give you the opportunity to give us a forward-looking perspective. You know, sort of if we were going to do this again next year. What do you think, you would either ideally like to have solved in this space, or you would hope to have solved? And Krista, you're obviously, near launching, so maybe your ask will be related to that. But go ahead.
I think beyond us, I'd obviously like to have, prove to ourselves that we've built a product that we think is as good as it is. But for the broader industry, I would like to come back and listen to both success stories and maybe even failures where folks have either bought technology like this, built it themselves, maybe borrowed some elements, and figured out what use cases are actually sort of tackleable. I don't know if that's a real word, but it is now. And then talk about some of the stuff where it doesn't fit. Like, I really liked Sabine's comment just now saying, well, we don't have demand yet for AI on the sustainability side. Maybe you'll never have it. Like, it's not a silver bullet, it doesn't have to be everywhere. But I do, obviously, having drunk my own Kool-Aid, what founder doesn't, believe that Samuel, Ali, lots of people in this room can benefit from these intern 2.0, which is a term that I will definitely co-opt from Sam. And just kind of cut through the complexity faster, because we really don't have time to be getting bogged down in the detail. There's always going to be complexity, for sure, because we disagree, we have different values, beliefs, and interests when it comes to sustainable finance and investing. But I think we can get to those sort of, okay, so where do we disagree? Where are the gaps? That point a lot faster, and then let the expert make the decision on what happens after.
It's a tricky question, to be honest with you. I don't know whether we have to look at our wish list or whether we're actually forecasting.
Wish list.
There isn't a single week goes by that there's at least one person complaining about data in ESG. So that is always, I don't know whether that's going to go away, frankly, or not. But a couple of years ago, I was responsible for submitting something around 400,000 data points to a European regulator on behalf of a company. Now, we had to...
That was 400,000 data points.
400,000. Yes, 37 templates. And there was a lot of firms coming to us and saying, we have this solution for you to make sure that what you're submitting is good. Now, fast forward, it's the same story. We have a lot of commitments, and there's firms who have solutions for buy sides to make sure that what they're submitting is correct. But at the end of the day, I think where AI can help, where fintech can help, is really making sure that, one, what we're getting is good in terms of quality. Number two, we would be able to use it effectively, implement it effectively. And what I mean by that is making sure that the comparability of the data across different spectrum, different vendors are okay. And number three, what I would like to see is from the regulator side, when they're looking at the data across all of the firms, they would be able to compare apples to apples. Now this, at some point, at some of these metrics, they're okay, but some of these metrics are hard. And what do we do with the metrics that are difficult to examine? Are we going to personalize these metrics based on what our view is? Are we in a position to say this should be the standard view globally and everyone should abide by that? And people would be able to reverse engineer and make sure that they're in the good spectrum. So there's a lot of conversation out there, and I would like to have some sort of resolution. If the resolution, I'm sorry, we're out of time, just one sentence. If the resolution is it's good to have different spectrum, it's good to have different ideas, it's good to have different colors, so be it. And that's a good thing. But if it's not to standardize it, then I would like to see where we are.
Very good. Samuel, over to you.
Yeah, so in general, So reducing the amount of manual work linked to data extraction based on the data that already exists seems a reasonable wish for this year. Then second, whenever there is a quick win and there is already a tool, an AI tool being built where ESG data can be integrated seamlessly, that will obviously be ideal, that we get all these synergies, these adaptations of the work that is being already done, as opposed to creating in parallel some ESG AI tools that would reinvent the wheel, not be directly connected to investment decisions, because a lot of the work we are doing is about integrating ESG into the existing process in terms of credit research, in terms of investment views. And in general, maybe number 3 is strengthening the consensus on areas where there can be a common view. And greenhouse gas emissions, again, is a classic example because there has been so much momentum in terms of disclosure standards, regulations. There can be one sort of single metric globally we agree on, and for a range of the sustainability metrics linked to the impact per se and objective metrics, that should or that's expected to progress. Obviously, for the subjective, qualitative components, there will be a necessary disagreement and various future developments irrespective of AI.
Sabine, le mot de la fin.
Merci. So I will have 3 wishes as well, since it's a wish list, so, but I'll keep it short, promise. The first would be, I would say, sustainable collateral availability. We need, if we want to have support of sustainability, we need more availability on the market. This will help. Second, I would say regulations, but not regulations in a sense of forcing buffers of sustainable assets or adding it as a measure that add cost, but more to add liquidity, in a sense, incentive for sustainability, like a waiver on liquidity, a waiver on HQLA formulas, LCR, etc. Second wish. And the third wish, I would say, it's as everybody was saying all of the day, is behavioral changes. Because even we as software, we provide a reduction of cost of operating sustainable products. With the collateral availability, with the liquidity waivers, we have growth. If there is no investment decisions in sustainability from all the market participants, vendor included, we will not have a better future for everybody, because economy is to service people, and we should keep it in our DNA. Sorry, it's French translation.
Thank you very much, Sabine. So we're finishing a bit late. Before we thank our panelists, I just wanted to make a quick announcement. Last week, we decided to create a joint task force between the work we do at the Executive Committee Principals and the work Georgina oversees. So there's a lot of member firms of ICMA. Be aware that there's going to be a venue to continue these conversations, data sustainability, but more generally on the convergence sustainability and fintech. And with that, thank you so much. And I think a round of applause to our panelists. Thank you.